Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video I am going to talk about the option collar strategy, how you can eliminate your risk almost completely. As an option trader, you can buy virtually any stock you want that has options that you can trade, and you can buy that stock risk-free. And so let's go ahead and do this. Now here you can see I bought some US Steel, ticker symbol X, and I bought 200 shares, and let's go ahead and go to the transactions here. And so here's what I did. Today is March 13, 2019, and so I did all of this yesterday on March the 12th. And so I bought 200 shares. Now you'll notice that I bought 35 shares at 2067 and 165 shares at 2065. And that's because I did a mouse error. And so maybe it's good that I did the mouse error, because the 165 shares I got 2 pennies less. But I just put 2060, we'll just average in the middle, 2066. So that's my dollar cost average of the 200 shares I bought. And then I bought to open 2 put options, and I bought the $20 put. It expires in 2021 January. It's a leap, and I spent $3.99 for those, for a total cost of $806. And then I sold to open 2 call options, so covered calls, and got $53 per contract, and sold 2 of them, $97. And so when I do this video, I'm going to talk about, just to make it easy to understand, like you're buying 100 shares, and then you can just multiply everything by 2, because I got 200 shares. So let's go ahead and go over the option collar strategy. Now the option collar strategy is as follows. First, you buy a stock, and I picked steel, and so I bought steel at $20 and what did I say, 66, and so that's 100 shares. Now if I were to just buy the 100 shares, then it could go up, it could go down. If it goes up, I make money, and that's wonderful. If it goes down, I lose money, right? So in order to prevent me from losing money, then the next thing I do is I buy a put option. Why do I buy a put option? Because a put option is a contract to sell my stock at the set price. That's known as the strike price. And so in this case, I bought a $20 put option. And if you'll remember, I spent $390, we'll say $400 for that. Now, if US Steel goes bankrupt, if it goes to $0, I got this put option that I can sell my steel at $20 a share. So it's impossible for me to lose my money. Now, my risk is the money that I spend on this put option, and also any gap in between where I bought the stock and where my put option is. So in this case, I bought US Steel at $20.66. I have put option that I bought, and it's at the $20 strike price, so that's $66. So that $66 is part of my risk, and that $400 that I spent. So my total maximum risk for every 100 shares that I buy of US Steel at $20.66 is $466. That's the most money that I can possibly lose between now and January of 2021. Now, if I wanted to, I could buy the 100 shares and buy the put option and just call it a day, and I could sit around and wait and wait and wait and wait. But the problem with that is when you buy put options, and when you buy any stock on calls or puts, call options, put options lose value over time. They are deteriorating assets. So the answer to that is you sell a call option. Now the trick here is when you sell to open a call option, you want to pick a strike price so that if the stock goes past that price, then the upswing in the stock will pay for the put option. So in this case, I bought steel at $20.66, and this is $24. So that upswing is $334. So that's the money I make. But really, now I have to look up the delta on this put. So in order to look up the delta, I actually got to go to a different account, because for some reason these Greeks aren't working for me on Ameritrade. And I did open account I did open a new account on Schwab, so I am going to go to Schwab, and I'm going to look up some option Greeks so I can look up the delta on that $20 put. Okay, so here's my Schwab. I got a little money in there. And just in case you're curious, I did do a put spread on Intel. I'm not doing videos on that, but I am doing a put spread on Intel. And so let's go ahead and go to and I'm brand new to this Schwab trading platform, but let's go ahead and go to Steel, and I'll try to bumble my way around this different trading platform here. So we go to the option chain here like that, and then we go under strategy and go to Greeks like this. And now I'm going to go to the $20 put, and I'm going to go all the way out to 2020. So, or I'm sorry, 2021. So here it is right here. And the delta on the $20 put is minus 34. But let me tell you this, okay? When I bought the stock at $20.66, this delta was a minus 37. So we'll just say minus 35, just to make the math easy here. So let's go back to Ameritrade. Now we know what the delta is, okay? So that means for every dollar that US Steel goes up, this put is going to lose $35. That's what the delta means. So if it goes up, delta is a negative. If I would have bought a call, then I would be making $35. So that means I make $100 if it goes up $1. I lose $35 if it goes up $1. So that gives me a net profit of $65. So I'm going to make $65 in profit for every dollar it goes up. And so if Steel goes all the way to $24, that's these two calls I sold, but we're just doing 100 shares. That's the call that I sold. Then that means I would make a total profit of the $3 times the delta profit, which would be 65 times 3, which would be 130, 195. I would make about $200 free and clear would be my profit if Steel went over $24 between now and May the 17th. That's the expiration that I sold the two calls. Okay, so since I bought 200 shares, then I can double that. I would make about $400, okay, because I bought 200 shares. So that's the option collar strategy in a nutshell. So again, the option collar is a very ultra safe strategy, because if the stock goes down, this put option gives me the right to sell Steel at $20 a share. Now, remember, I spent $399 for those put options, okay? So if I am able to sell to open calls, and for the next, between now and 2021, for the next almost 2 years, for the next 22 months, if I can bring in $399 plus that $66 gap. Remember, I bought Steel at $20.66 per share, so that's a 66 extra dollars that I got to cover. So if I can make $466 between now and the next 22 months, then guess what? I own this put option will be paid for, that gap risk would be paid for, and that basically means that I can own these 200 shares, and I can own them between whenever that day is and to the end of this expiration. And for all of that time period, however long it takes me to make that, for that entire time period, I get to own these 200 shares of Steel for completely risk-free. And that is a great way to invest. Would you agree? If you could find a way to buy a stock, and if the stock goes down to zero, you don't lose any money. Isn't that a wonderful way to invest your money? So I do option callers all the time. I did option callers on Twitter last year. I did very well doing that, and I'm doing it now on Steel. And now let me go to the chart, and let me show you what Steel has been doing. So here's the chart, and let's pull up the full featured chart here. And so Okay, let me get rid of that. Okay, so this is a history of steel. Steel, this stock has been around since 1992, and it's been kind of a ranging stock, flat stock until here when it just really went up super sky high. I have no idea why it went up so high, but it went almost to $200 a share. And then it came crashing all the way right back down to $20 a share. And then ever since that point, that was in 2008, I guess that's the reason why it dropped back down, the recession. Ever since 2008, it has been ranging ever since. Okay, and so if we were to shrink this down, and this is a 5 years chart here that I'm shrinking it down to, then you can see its range is at the top here and at the bottom here. And it only went down here once. Okay, it's like all the way to $8. I only did that once. So really, its real support level is right around there. And you can see that steel is very close to its low. Boy, these things are annoying. So I just felt that it was a good time to buy some steel, and I actually learned about this when I was doing my last video, because my last video I was talking about the covered call strategy, and somebody sold some covered calls. They bought some US Steel up here at $28 a share, and then they made a post in a Facebook group about it, and it dropped all the way down. And so I did a video about that. The covered call strategy, I don't like the covered call strategy very much, but the option caller is basically the same thing as a covered call strategy, but you're just buying some puts, so you actually get some real protection, unlike the covered call strategy, which doesn't protect you worth of a squat. So I don't like the covered call strategy, but I love the option caller strategy. I think it's a super safe strategy. And let me go back to Ameritrade and let me explain something here. So again, if we go back to my transactions here and we look at the price that I bought those puts, you can see that I bought them. Where is it at? Right there. There it is, $3.99. So basically $400 a put plus their $20 puts, and I bought US Steel at $20.66. So my maximum risk per 100 shares is $466. So if I can find a way to sell call options, sell the open call options, covered calls, and I can bring in enough money between now and all the way until January of 2021, then that means that my put option is paid for, this gap is paid for, and I own the stock completely risk-free. Now, let's take a look at the calls that I'm selling. Okay, so these calls, let's go back to my transactions here, and let's look at the calls that I sell. So here's the calls that I sold. $24 call, took in $53 per contract, and those expire May 17, 2019. That's about 2 months from now. It's like 65 days, okay? And so if I make $53 in 65 days, that's about $25 a month, right? Now, I have 22 months left in the life of this put option that I bought, this put right there. I have all the way till 2021. So if I'm making $25 a month for the next 22 months, well, 10 times 25 is $250. So 20 months, I'm making $500. So you can see I've already paid the put. And if I can continue to make the same premium, $53 every 2 months, I'll make $500 in 20 months, okay? And then I'll make a total of $550, okay? And that covers my risk. That covers everything. Everything is covered, and the strike price is up here at the $24 level. So the worst case scenario is I'll make $550. Maybe I lose all the money in my put, but that's okay, because if I lose all the money in the put, the absolute worst case scenario would be for steel to drop below $20 a share. And if it dropped below $20 a share, then I would lose the $66. I would lose $466, but I would make $550. So I'd make a $90 profit. That's the worst case scenario. The best case scenario is if steel goes above $24 a share between now and the next 2 months. I'll make a nice clean profit. Okay, and then I got all sorts of choices. I could sell higher call options, I could roll them up, I could get out of the trade and take a profit, I could even buy more put options and buy higher strike price and just continue to protect myself all the way up. And there's there's lots of flexibility, lots of choices that I have when I do option collars, but the basic premise here is you buy the stock, you buy the puts, and you sell the calls. You buy the stock because you want to make some money. You buy the puts because you don't want to lose the money. And you sell the calls because you want to pay for the puts that's preventing you from losing the money. That's the way the option collar works. It's an ultra safe strategy. And again, if I make that same $25 a month, $53 every 66 days, then even if the stock stays flat, if it doesn't budge, I will do okay. I will make money, and this premium will go up because I'll sell lower strike prices, okay, and I'll bring in $60 or $70 or $80 a month, or every 2 months, right? And I'll be making $40 or $50 a month. So this premium will go up. So there's a lot of potential here, okay? So ultra safe strategy. The option collar is a wonderful strategy, and you can do this. There are lots of stock. There's dozens, maybe hundreds of stocks out there that you can do option collars. So I picked the option collar because I'm doing my diagonal spread with Microsoft, and it's kind of going against me because I have 2 puts and 1 call, and so I just have to wait it out and collect my premium on the calls and the puts that I'm selling. I did do a rollout on my 108 call, and now I sold the open a 110 call, and I rolled it out to April the 12th. And I took in another debit, but that's okay because instead of the money going to the premium, the money gets transferred into the intrinsic value of the call. So even though it doesn't show up in my cash balance, it's still there. And at any time between now and April the 12th, I can sell that call, make a profit. Now my problem here is because Microsoft keeps going up, these put options are losing some value, and so I'm taking a little ding. I think overall in the entire spread, I'm down about $150. So it's certainly nothing that I'm panicking about. My plan is just to keep selling puts. If Microsoft keeps going up 114, 115, 116, then I'll sell 111 puts, 112 puts, 113 puts, and I feel totally confident I'm going to bring in enough money. But the diagonal spreads are more volatile than the option collar. The option collar, I consider that money in the bank. The option spread, much higher possibility to make a lot of money. Okay, with the option collar, you got to be happy with the fact that you're probably only going to make about a 10% return per year on average. But with the diagonal spread, that's not the case. With the diagonal spread, you can knock it out of the freaking park. You make a lot of money, but it's pretty volatile, and you just got to be ready to deal with that. And so now I got a little bit of diversity going here in my account. I got the diagonal spread, and I got the option collar. So I feel good. I hope you enjoyed this video. As always, if you got any questions at all about anything that I talked about, feel free to leave it in the comments section. So that's it for this video. Thank you for watching, and I hope you have a good day, and I will see you in the next video.